We have our next testifier, and that is Jean-Pierre Aubry, Associate Director of the State and Local Research Center for Retirement Research at Boston College. So welcome very much, Jean-Pierre, and thank you for testifying. And let's carry on.
Great. Okay. I just want to thank you for allowing me to speak today about some recent research that me and my colleagues have done at the Center for Retirement Research at Boston College. It's my sincere hope that this research will further inform the pension discourse being had here at the Commonwealth. My presentation today is going to summarize two recent briefs by the Center that are focused on public pension investments broadly. The briefs assess plan performance in two ways, one by comparing plans to each other, the other by comparing plans to their own benchmarks. The analysis is based on the Public Plans Database. It's a database we maintain at the center. It's 180 plans across the U.S., major state and local systems. That covers 95% of all members and assets. So it's very comprehensive. Any assessments I have of Pennsylvania schools or Pennsylvania SERS in this presentation will be generally to kind of compare at a high level where those two plans fall relative to this public plans database universe. And also, it just has another shameless plug while I'm here. The center has also recently released a investment comparison tool where we've collected data from the CAFRs of these 180 plans from 2001 to 2017 on allocation, performance by asset class, benchmarks. That's all available on this tool made to for easy visualization and comparison of the plans in our sample. So hopefully, for those that are interested in more detailed analysis, that may be a tool that, that you can use. Okay. So the CRR assesses plan performance in two ways. A comparison of investment returns across plans, where the observed differences between plans are the result of differences in allocation and differences in performance by asset class. And then also a comparison of each plan's investment return to its own benchmark, where performance relative to the benchmark really tells you how a plan is doing in terms of executing its own strategy. So for the first assessment, comparing plans. The long-term, this is 2001 to 2016, investment return for public plans in the PPD varies greatly. So here we have a range of returns, and I've kind of highlighted where Pennsylvania schools and SERS falls within the distribution. It's kind of in the lower end at the bottom of the third quartile and the second quartile. But you can see there's a dramatic range in terms of the overall performance of plans over the long term. And this difference in return is actually very meaningful. So what we did is took plans in the bottom quartile that performed at the bottom quartile over the whole period and plans at the top quartile and just kind of flipped their returns, kept everything else the same, and said where would the bottom quartile be if they had the same cash flows, same benefits in, same benefits out, same contributions in, but had top quartile returns, and vice versa for the top quartile. And you can see they roughly switch places. Right, so the bottom quartile goes from 60% funded today. If they had top quartile allocation or returns, they'd be 88% funded. For the top quartile, it's 79% funded. They would drop down to 63. And so it just explains how much this variation in returns explains the diversity of funding ratios that we see today. So at a high level, the asset allocation of most public plans is quite similar. So we look at these four quartiles again and look at three broad asset classes: equities, fixed income, and basically everything else, which we call alternatives. And they generally are the same. You know, you have differences of maybe 2 or 3% in every asset class at most. So from our perspective, that's not that much variation within the sample. But the top quartile plans outperformed other plans in most asset classes. So you don't see a lot of difference in allocation, but you do see difference in performance by asset class. And so this highlighted column just shows that in terms of public equities, fixed income, private equity, real estate, that the top quartile really outperforms I think what's most striking in this table is the difference in the public equity returns, right? Most plans, public equities are the largest part of the portfolio, so how you do in that asset class really matters. The top quartile got 6.7% returns over the whole period, while the bottom got 4.7. Looking deeper, a lot of that is due to domestic versus international allocations. So that top quartile was in international equities, more heavily weighted international equities prior to the crisis, when those did better than domestic equities. After the crisis, they were flipped, and the top quartile plans were more heavily weighted toward domestic, when that's been better than international. So that's kind of what's happening there. So given that allocation is so similar at a high level and that top quartile plans clearly outperform in most asset classes, the real difference in performance is returns. It's actually not that much allocation. And so right here on the right, we show an average of all plans and what explains their difference from the top quartile. And most of it, on average, is about a 1% difference between the top quartile and everybody else. Almost all of that is due to differences in asset class returns, and almost none due to allocation. So that's for most plans. In general, plans have shifted away from traditional stocks and bonds and into alternatives. So you basically see here what's been happening in public plans at large, going from about 10% to about 25% in alternatives over the period. And all plans have made a very similar shift away from traditional bonds in a relatively similar, have made a shift away from traditional bonds in a relatively similar fashion. So, you see basically all the plans clustered together in terms of fixed income portfolio, and they're all kind of going down at a similar pace. However, after the crisis, the bottom quartile plans made the largest shift out of equities. And so here you see a really dramatic change in the ranking in terms of equity allocations between the top and bottom quartile. So leading into the crisis, the bottom quartile was heavily weighted towards equities, took a big hit in the crisis, and they also shifted out of equities right after the crisis, so they didn't get any of that rebound. And the shift out of equities was coupled with a shift into alternatives right after the crisis. Specifically, it wasn't just any type of alternative. The bottom quartile plans shifted a lot more into hedge funds and commodities relative to others. And so what you see here on the left is how much more. They have about 10% in hedge funds compared to the other quartiles, which are around 5 to, at a high, maybe 9. And they also have more in commodities. It was during this period when hedge funds and commodities dramatically underperformed the other asset classes. So here we just show some index returns for various alternative asset classes and traditional equity. The private equity index we use is the Thomson Reuters Private Equity Buyout Index. Other indices show slightly lower numbers, something around the 10 to 12% for private equity, but nothing as low as hedge funds and commodities, which are barely breaking even. So as a result of the shift in allocation, the dramatic shift in allocation for the worst plans, allocation actually played some role. So for most, they're generally the same. It's really asset class returns, but you do see for the worst performing plans a little bit of an allocation story, being in equities leading into the crisis, shifting out of them after, and shifting into hedge funds and commodities precisely during a period when they were the worst performing asset classes. So that was an assessment comparing plans to each other. The next is comparing each plan to its own benchmark and seeing how plans measure up in that sense. So most plans beat their benchmark for traditional investments. So we had, but only half beat their benchmark for alternatives. So we have 72% of plans exceeding their long-term benchmark in equities, 92% of them exceeding it in fixed income, but only just over half exceeding their benchmark in alternatives. Now at the portfolio level, The benchmark for most plans reflects their asset allocation, but there is some variation, right? So the majority do a weighted average of their asset class benchmarks, but some use a peer universe. Others use the expected long-term returns, the actuarial rate of return, and others use an index plus a premium. Sometimes that's a T-bill, other times it's S&P plus, but there is some variation. I think it's important to note here that each benchmark is useful for very different reasons. I don't think there's a right benchmark to be used. I think the weighted average of asset classes gives you a sense of how a plan is executing its own strategy. Peer universe tells you a little bit about how a plan's strategy is performing relative to others who may be doing different strategies. Expected rate of return is more of a long-term assessment to see how your return compares against what's needed for funding reasons. And in the index, that may be for looking at how the risk premia of your portfolio is if you have a T-bill as the index. So when we were assessing plans meeting their benchmark, we utilized a weighted average of all asset classes. So we have benchmarks for each plan reported by them for each asset class. We take a weighted average of that based on their own allocation to those asset classes and compare that to their actual performance. So this question really, the benchmark we're using answers the question, how does a plan do relative to its own strategy? So we don't worry about the fact that some plans have very different benchmarks for very different reasons. We kind of use the same benchmark for everybody. What we find is about a third of plans meet that weighted average, do not meet that weighted average benchmark. So about a third don't execute their plan to their expectations over the long haul. And plans that fell short of their benchmark were also more likely to be in the bottom quartile relative to other plans. So it may be that plans that fell short of their benchmark actually just had higher benchmarks. So they may have actually performed better relative to others, but worse relative to their own standards. But this chart suggests that's not really, may not be the case. 38% of plans that underperformed their benchmark were bottom quartile plans. So they were just bad performers relatively as well as compared to their benchmark. For overperformers, you only see about 22% being the bottom quartile. So it suggests there's kind of potentially less shenanigans going on with the benchmark than you might think. So what about fees? Our data show that most plans report between 30 and 50 basis points in terms of annual fees. So what we did is we calculated a long-term return from 2001 to 2016, assuming the plan paid no fees, and then using their netted fee return, and compared that long-term return to get kind of an average fee over the whole period. And that came to 30 to 50 basis points. Our estimates for Pennsylvania was closer to 70 to 80 basis points. So they were at the high end, very high end, of the average fee paid over the whole period. I guess you can go back one, sorry. But what was interesting is we found that fees played a somewhat limited role in the relative performance of plans, so that if you look at gross returns and net of fee returns, plans basically stay in the same quartiles. That's not to say there's some movement within plans, but there's not big jumps due to fees being paid. So it's not that if a plan did not pay fees, it'd be top quartile, and it's paying fees, so now it's bottom quartile. It just didn't seem that dramatic. And so what we see here is that 70% of plans don't change their relative position to other plans if you look at their gross return versus net return. And then there's about 15% that move up a little bit, 15% that move down a little bit. Now, plans that fell short of their benchmark, they did pay higher fees across all asset classes. So they did pay more, and they did fall short of their benchmark. But that doesn't mean exactly that the fees are the reason for that. And we show this in our next slide, where we look at where they would have been relative to their benchmark if they paid no fees. For most plans, it would take a cut in their fees of almost 50% for them to have achieved their benchmark. So presuming that kind of fee cut is exorbitant, you would think that maybe fees aren't the reason why they didn't hit their benchmark. Most plans, almost 60% plus of plans either needed more than 50% or couldn't even hit their benchmark if you removed their fee totally. So it really speaks to how fees are not the whole reason why plans are underperforming. It's part of it, not all of it. So what do I take away from these figures and these summaries? One is that the observed differences in long-term investment performance among plans is meaningful, that there actually is a wide range of performance from 2001 to 2016, and it matters in terms of how we explain differences in today's funded ratio. For most plans, the difference is due to asset class returns. Most have very similar allocations. But for the worst performing plans, the allocation to hedge funds and commodities after the crisis definitely played a role. Now, while most plans outperformed their benchmarks, the third of plans that did not were also more likely to be the bottom quartile relative to others. So these plans underperformed relative to their peers and relative to their own standards. But these plans that underperformed their benchmark, they paid higher fees. But in many cases, even if they paid lower fees, they wouldn't have hit their benchmarks. That's not the only story for these plans. They're underperforming for other reasons. So here I have an appendix of just kind of disconnected items, but I think are relevant and interesting about Pennsylvania, and I wanted to get a sense of how different it is relative to the universe of public plans in the database. So the first thing I look at is a simpler allocation. What happens if you just go 60-40? And here we define that as Wilshire 5,000 versus 40% of the Barclays U.S. Aggregate Index. Then I'm going to look a little bit at what other public pension plans use leverage explicitly in their investment strategy. Then looking at how plans value their investments. And finally, looking at unfunded commitments, so plans that commit to put money into private equity funds or real estate funds, how those unfunded commitments may play a role in their future liquidity. So the benefits of a simpler investment approach really depend on the period in question. Right, from 2001 to 2017, the majority of plans in our PPD sample outperformed a simple 60-40 stock bond portfolio, and this is not that sensitive to what indices you use. Whether you're using S&P 500, Russell 3000, this narrative holds true that over the whole period they've outperformed, but since the financial crisis, a lot of plans have underperformed. And for SIRS and PSIRS, the story is similar. Again, you may quibble about exactly what the levels are, depending on what index you use, but the narrative is that over the whole period, plans have outperformed these simple alternatives. But really, since the crisis, we've had kind of a different investment environment where indices are really outperforming other kinds of allocations. So one characteristic that stands out about Pennsylvania's school system is the explicit use of leverage. I didn't see that as a common feature in a public plans database, so I spent the last couple of weeks kind of combing through some of the CAFRs of our public plans in our database to see what other plans explicitly said they use leverage. Many plans talk about the fact that their private equity portfolio managers are able to use leverage, or that their real estate managers are able to use leverage, but only a few really talk explicitly about the plan leveraging. And so here, I think it's a total of maybe 10 systems across the 180 that we have in our sample that actually explicitly use leverage. And those that do, it's usually a pretty small amount, under 10%. There are 3 plans that stand out: Pennsylvania Schools, Missouri State, and Ohio Police and Fire, that use significant amounts of leverage to achieve their returns. I also reviewed the classification of plan assets. So starting, I think, as of 2015, plans were asked to report the valuation methods for their investments. So there are 3 levels. Level 1 is really liquid assets that can be marked to market very easily. Level 2 are those that have observable characteristics, but maybe not traded frequently. This is something like a municipal bond or a corporate bond. And then finally, level 3, where there are significant variables that are not observable when you're doing your valuation. These generally involve models for things like real estate valuations. And then there's net asset value. And so that captures a lot in the net asset value. That generally tends to be what would otherwise, I think, be classified as level 3 assets, right? These are private equity funds, real estate funds, where the system is given a share of the net asset value of that fund, and that is reported to them from the fund manager. In many cases, these are what we would consider level 3 assets. So you may want, when thinking about the liquidity and the ability to value fair value of a plan's assets, it may be prudent to combine the two, NAV and level 3. Finally, as the growth in alternative space, as the alternative allocation has grown among public plans, part of that is the commitments you make to alternative investment funds, private equity funds, real estate funds. Commitments are, I think we've had other speakers discuss this, that commitments are lumpy, distributions are lumpy, that you have capital calls that are made to the fund over time as the fund needs money to invest. And so what I show here is unfunded commitments, so amounts that the plan has promised to give but has not been called yet to these funds as a % of assets. As you can see, both PA CSRS and PA schools are at the upper end of the distribution. The majority of plans, their unfunded commitments fall below 10% of their assets, but for CSRS and schools, we're at 12 and 16 respectively. So that is a significant level of unfunded commitments that could limit the flexibility for the plan going forward in terms of its investments. Basically, 10% of his assets are potentially callable at any given point from the private equity or other alternative investment fund. So that concludes my summary of our 2 briefs, as well as some high-level data from the public plans database. I welcome any questions on our data or the research I've shown here.
I appreciate your testimony, and your testimony comes to the conclusion that fees are not the reason for underperformance. Your data shows that the fees are not high enough to cause them to move to another quartile or really change their performance in their peer group. But it also tells that higher fees aren't necessarily correlated to top quartile performance as well. Is that
right?
Fair to say?
Right. And so I think that the takeaway here is that, to be clear, right, less fees are always better. More bang for buck, generally. If for any given return, if you're paying less fees for that, it's more take home for the plan. But our data doesn't show any real relationship between fees and underperformance or overperformance. So we have not been able to extract that from our data as of yet. Mm-hmm.
It's an interesting thing that we're all seeking value, right? We're the value proposition. Other questions from the Vice Chair?
Thank you very much. Thank you for your organization's work, which I think is hugely important to not just us, but to the folks around the country. A couple questions, but on the fee thing, understanding the nuances of this, that if you're performing here in gross fee, you're not going to, it's not going to change dramatically as you go. You did say that you thought Pennsylvania's fees were very high relative to your 30 to 50% you typically see. I'm having trouble understanding the correlation. I thought your report said, well, your report says data show a correlation in higher fees and worse relative performance. I thought we were saying today is that the magnitude of impact that can come from fees depends on how dramatically you can cut it and where your levels are. But Are you saying there's no correlation, or there is that correlation?
So what we found is that plans that underperformed paid higher fees, right? So there is a correlation, I guess, right? Causal is hard, and as shown by the fact that if we add back in fees for plans that underperformed, it doesn't cause them to overperform, right, or meet their benchmark. So there is definitely a correlation between the fee that plans pay, and their underperformance. But it's not clear that fees are the reason why they underperform.
Correct.
Yeah.
Okay.
Yeah.
And the other takeaway I have from your testimony is that we really are outliers when it comes to the amount of potential unfunded commitments that are out there, where 68% of all funds have as much or less than we do, and we're a real outlier when it comes to the use of leverage at the portfolio level.
Yeah, that's absolutely correct. I mean,
not that we didn't have enough to worry about with our funded. Yeah. Okay.
right. And you can consider the unfunded as another liability that the plan faces, right? And it's just unlike the benefits paid through pension fund, that's somewhat predictable. The liability for unfunded commitments is much less predictable. And my sense is that opportunities arise when markets depress, and that's also when a plan is otherwise liquidity constrained. So there may be kind of correlations there that could be troubling in terms of the unfunded commitments and when those are called.
At the time, we'd most want to take advantage of the opportunities we might be least able to.
Yeah.
Great. Thank you.
Commissioner Gallagher?
Thank you, Mr. Chair. Mr. Aubrey, thank you for being here. I've benefited from your research over the years, trying to help better educate the caucus that I serve. And so thank you for that. I do have a couple questions for you. At the center of all this, you're deriving conclusions from your database. Is your database solely sourced by CRR staff completely from soup to nuts?
Yes, so the data is extracted directly from CAFRs by the center, so we don't, the data is from reports released by plans. And to the extent possible, we have plans vet our data as well. So there's a process which we send the data to plans, and there's a review period which they can look that over. And so that's our process, but we try to do as little massaging of the data in the reports as possible.
Sure.
And so it comes directly from plans. For that reason, it can be limited. There can be variation in how plans report within a plan over time and across plans. But we find that on the whole, it provides some clarity as to kind of broader trends in the public pension universe.
Our system, or one of our systems, our state employees retirement system, had done some research of another entity, the Pew Charitable Trust, and identified inconsistencies in the data that they captured for comparing plans. And so I want to extend the invitation to maybe reach out to our systems and see if your data is aligned with what our systems have for reporting fees. So if I can make that request. And then a second part to it is any of the research that we've heard today funded by the Laura and John Arnold Foundation or from Pew Charitable Trusts?
So our investment data is funded by the Arnold Foundation. We're currently pursuing a 3-year project with their support to collect data on investments specifically. So that's the only portion. The rest of the PPD and the rest of our database and analysis is funded through other bodies such as the state and local, Center for State and Local Government Excellence. The PPD is done in partnership with NASRA, and they vet anything that goes in the PPD. So all the data that we've collected is funded by the Arnold Foundation. For it to get onto the PPD, it has to pass muster with NASRA and the Center for State and Local Government Excellence.
Okay. Thank you.
Okay. We appreciate your testimony, and as Commissioner Gallagher said, we may very well be back in touch with you to extract more of the information that you're compiling. Thank you very much.
Looking forward to it. Thanks.
Okay, we've got 2 testifiers left, and our next testifier is Miss Kristen Doyle, CFA, Partners Retirement and Investment for the Aon Hewitt organization. So we appreciate you being here. We apologize that we're a little bit behind schedule, and it's getting towards the end of the day. However, we're anxious to hear your testimony. Thank you.
Great, thank you. Commissioners, thanks so much for having me today. So as you just mentioned, my name is Kristen Doyle. I lead our public fund business at Aon Hewitt Investment Consulting. We at Aon Hewitt Investment Consulting in the U.S. have about $1.5 trillion in assets under advisement that are in the public sector. And we work with probably about a third of the top 50 largest state plans in the U.S. We have about a 30-plus year history of working with public sector pension plans. And I personally work with 3 of our largest relationships. I work with the Florida State Board, which is a $160 billion plan. You heard from Ash today, who is the executive director for that plan. I also work for the New Jersey Division of Investment and the State Investment Council there. And I also work with the Minnesota State Board of Investments. Both of those plans are about $75 billion in assets, so very similar in size to some of the plans here in Pennsylvania. So I have 2 main sections to my presentation today. One is to provide an overview of asset allocation for institutional investors, talk about best practices and how to set asset allocation, and then the importance of diversification. And then the second part of my presentation is related to best practices on benchmarking. Next slide, thanks. So before I dive into asset allocation, I did want to just remind the Commission of how asset allocation fits into the overall pension accounting formula. So this depiction that you see here illustrates it's a complicated way of showing a very simple formula, which is that investment return on assets, or an asset return plus the contributions, is what funds the overall liabilities. And what defines the liability is primarily, obviously, the benefit levels. So said even more simply, contributions plus investment return equals benefit payments. And this has come up a few times today, but I did want to mention that there are a number of states, and I believe here in Pennsylvania this has happened, where there's been a study of where the underfunding has come from over time. And the state of Kentucky has recently done this. Colorado's done one. I believe New Jersey has done one. There's a number of other states that have. And typically what is found is that the primary contributor to significant underperformance over time has been the underfunding. So we're going to talk about asset allocation and asset return today is obviously extremely important. I was actually just at the Florida State Board meeting this past Monday, and they've earned net of benefit payments over the last year $9 billion. So if those assets had been sitting in cash, they wouldn't have an additional $9 billion to contribute. So I don't want to diminish the importance of the assets and the asset allocation and the investment return, but note that there is another key component to the pension formula here. So what is asset allocation? So when I talk about asset allocation today, what I'm referencing and referring to is the actual implementation of an investment strategy that more than anything is seeking to balance the need to earn investment return, but also take into the account the risk of earning that particular return. And you can define risk in a million different ways. At Aon, the way we think about risk, and the most important risk, is permanent loss. So that's the permanent loss of not having the assets that you need, or having to sell assets at a permanent loss to make benefit payments. So certainly risk can also be defined as the volatility of returns. So it's hard to ride out volatility of returns. So we want to minimize volatility as much as we can with asset allocation. And that's certainly an important piece, and that goes along with the risk of permanent loss. We'll also talk about diversification, as I mentioned, but if all of your assets are falling at the same time, that risk of permanent loss is greater. And so to the extent that you have some assets that are performing well while you have other assets that aren't performing well, then you limit that risk of permanent loss. I also wanted to mention that when setting asset allocation, it should be done by looking forward, not by looking backward. So we'll talk about benchmarking in a minute, which is definitely a look backward on how the plan has performed over time. And that has certainly a very important place in evaluating pension plans. But again, when we evaluate and assess asset allocation, what we want to make sure that we're doing is that we're looking forward and positioning ourselves for what we think and what our experts think will be the market environment, let's say, over the next 10, 15, 20 years. So there's been a number of different studies over the past couple decades that have shown that asset allocation is the most important decision that an institutional investor makes, and that it is the number one determinant of investment return and investment return variation over long periods of time. And that's why it really is best practice for boards to set and vet asset allocation. And you heard Ash today from Florida indicate that his board is a policy board. And so what they do is they pay the most attention to the asset allocation investment policy, which again is a key determinant of the overall success of the program. So this is a lot of words on a slide. Let me try to summarize. So really the point is that every investor has different circumstances, characteristics, liquidity requirements, liability profiles, and risk tolerances. And all of those factors is what should inform the asset allocation. So the spectrum of allocations and the way we define it from, on the left side of the spectrum, an efficiency investor, which is an investor that is going to look for a higher reliance on market risk, so taking the market return that it gives them, the need for more liquidity and less active management, less active risk. And then on the far right is what we call opportunity investors. And on the far right of that spectrum is where you're going to allow for more private market investments, more active strategies as opposed to passive, and generally, but not always, being able to take more liquidity. I've also listed a few key determinants here that help you determine where you might fall on that spectrum. So those are things like governance structure. So there are governance structures that allow the investment team to be more nimble or less nimble. There are time horizons. So most public pension systems are going to fall on the long-term time horizon spectrum, with the exception of maybe like Puerto Rico. And actually, I used to consult on the teachers plan down there, and so as they were running out of money, we made drastic changes to their asset allocations. That was a very different experience for a public pension system, where they ended up on the far end of the efficiency side of the spectrum. But most public pensions are going to have a longer time horizon, and so that should inform the way that we invest. And then thirdly is portfolio size. So the larger the plan, typically the larger and more sophisticated the internal investment staff. And also that goes hand in hand with the ability to sort of prudently invest in private markets due to investment knowledge and capability and expertise to select the best managers, to understand the complexities, and also the size needed to access the best strategies and to maintain diversification. And the one thing I didn't put on this slide, but I wanted to make sure I mentioned, is that we'll also want to think about and identify a plan's competitive advantages. So that's one thing we've been talking a lot more to our clients about, is sit down and think about what your competitive advantages are and maximize them. So Ash and David both talked about a lot of internal management. That's a competitive advantage for them. That's most likely a competitive advantage here because of size and because of resources. So that's something that you want to make sure that you maximize, because it can have huge benefits the way you manage your program. That's just one example. So asset allocation certainly has changed for institutional investors over the past 50 years, probably most dramatically over the last 20. Most of this has been driven by quality structure and the sophistication of different asset types, but also the emergence of new capabilities, the increase in skill, both for institutional investors and also investment managers. And importantly, the terms that are now more favorable for investors than they have been in the past, and better align interests between investors and managers. So diversification is extremely important. The Uniform Prudent Investor Act, which defines the responsibility of a fiduciary, it was adopted in 1992 and has since been adopted by all states, either in its entirety or in part, basically requires and explicitly requires that diversification is a duty for prudent fiduciary investing. So it's something we definitely want to make sure that we pay attention to. And I have a very simple illustration here that basically shows that when we're just talking about stocks and bonds, very simply, a lot of times when stocks are up, bonds are down. When bonds are up, stocks are down. And so if you're investing in both asset classes, you're getting the benefit of that. So you're not up a lot when stocks are up, and then down a lot when stocks are down. You have a buffer that allows you to manage through difficult periods of time for stocks or for bonds. I have an example of what that looks like in practicality. So this, again, is a very simple example. But if we have investment A that in year one was up 20% and down 10% in year two, you would end up with a cumulative return of 8%. So I did sort of the dollar math on the bottom for you there. So you'd end up with $108. If you were in investment B, which behaved exactly the opposite, in year 1 down 10%, year 2 up 20%, you would end up in the same place. You would end up at an 8% cumulative return. But if you allocated 50-50 to each of those assets that are performing very differently in year 1 and very differently than each other in year 2, you actually end up with a 5% return in year 1, so a lower return than you would have had with investment A, but a much higher return than you would have had with investment B. Vice versa for year 2, but again, another 5% return. So you would have compounded 5% over a 2-year period, and you would end up at $110.25. So just a simple example that illustrates how diversification actually can benefit an investment program in terms of cumulative return. And of course, there's a spectrum of risk and return profiles. So this picture just illustrates that cash and bonds fall in the lower end of the return and risk spectrum, and equities, as you would expect, and private equity carry a higher expectation for returns and then therefore a higher level of risk. So let me move on to benchmarking. So once you've set the asset allocation and are implementing it, then you need to measure its performance. But it can't be a binary approach. So meaning that you don't want to just look at one type of measure of performance. There are many different ways to measure and monitor performance over various time periods, and I'm just going to describe a few of those quickly. But before I do that, I just want to make sure that we're all clear that benchmarking is essential to good governance. This is a really important piece of fulfilling a fiduciary duty to a pension system. So there's a couple different types of benchmarks that I've listed here. The first is typically used in the public markets to represent the broad opportunity set for a particular asset class. So this is a broad benchmark like the Russell 3000 that represents the entire universe or opportunity set of U.S. equity stocks. The MSCI All Country World Index, what I list here as an example, represents the entire global opportunity set for publicly traded stocks. Those broad benchmarks can also be sliced and diced by style and by market capitalization so that you can have benchmarks for more focused investment strategies, if that makes sense. So that would be like a value-based index or a growth-based index or a small cap index. I said that measuring can't be binary, so there's also other types of benchmarks like a risk-adjusted benchmark. That's a good example of a different way to look at performance. So we really recommend that you look at return in the context of how much risk you have to take to get that return. So you could have a really, really good return. So if you look at U.S. equity stocks over the last 12 months, ended at the end of August, they're up 20%. So that's a really, really good return. If you look at that return in isolation, you don't understand how much risk you had to take to get there. So that's why we advocate using a risk-adjusted benchmark as well. Over longer periods of time, there's other more absolute return-like benchmarks that are useful. 7% return target might be, so your actuarial assumed rate of return, for example, might be an important thing to look at over longer periods of time. We definitely don't advocate using those in shorter periods of time. There's too much noise, and it can cause bad behavior and bad decision-making. There's also real return targets. So if your plan has an objective of beating inflation plus a premium over a long period of time, and that's an important objective for you to measure, and a number of public pension plans do use that type of a long-term benchmark, that's appropriate as well. And then peer universes, of course, are interesting to look at, and we provide that to a lot of our clients too. So just to reiterate, a really important function of a board and also of third-party consultants like ourselves want to ensure that those that are without conflict are setting reasonable and appropriate benchmarks. So we spend a lot of time with our clients helping them set benchmarks. So what you don't want is your manager, your third-party manager, telling you what benchmark you should be using. They can help inform what benchmark you should be using, but you really want to take an objective, conflict-free approach to setting these benchmarks so that your constituents and other key stakeholders are comfortable that you're actually measuring your performance in a very objective way. So I've listed a few characteristics of a good benchmark here. They spell out samurai. I'm not sure if that's just a coincidence or why that is, but anyways. So let me just list them quickly. So specified in advance, we want the benchmark to be specified prior to the evaluation period because we know hindsight's always 20/20. We want it to be appropriate, so we want it to be consistent with the investment style or the area of expertise or the opportunity set that we're trying to measure. It should be measurable, so it should be able to be calculated. That seems very obvious, but that's an important characteristic. It should be unambiguous, so we should always know what's going to be in the benchmark or what's in the benchmark. So we should be able to peel back the hood and look inside and see what's in there. It should be reflective of current investment opinions, so that the manager should have knowledge of the securities and the factor exposures that are within the benchmark. So a really silly example, but one that I think maybe explains this, is if your manager is only investing in small cap stocks and isn't considering mid cap stocks as a place that they are looking, they don't know anything about mid cap stocks, you wouldn't want to benchmark them against a small and a mid cap index. You'd want to stay with the small cap index. It should be accountable, so the manager is aware of and accepts accountability for the benchmarks. So that's more at the manager level. That wouldn't apply necessarily at the total fund level. And then it should be investable. So these are all really important characteristics of a good benchmark. Now, I will make the comment that these are pretty easy to fulfill across the board when it comes to public market benchmarks. It's a bit more difficult in the private markets, although there are really good private market benchmarks, and they've improved dramatically over the last 10 years. So before I talk about private market benchmarking, which is my next slide, I just wanted to quickly, I don't have a slide on this, touch on total fund policy benchmarks and asset class benchmarks. So we believe that the best total fund policy benchmark should be a passive representation of the broad asset classes included in the established asset allocation policy. And this was mentioned by the testifier before me. So what this does is it does two things. It measures the deviation of actual investments relative to the investment policy. So if there's a overweight to equities, for example, it's going to measure what impact that had on the performance. And it also measures the implementation of the asset classes. So how are the asset classes, the implementation of the asset classes performing relative to the benchmark selected? Changes, this is important too, changes to the total fund policy benchmark should always be applied going forward, should never be applied going backwards. And as there's changes to the asset allocation, those should always be reflected in the total fund policy benchmark. There's a couple other total fund benchmarks that can be used as secondary benchmarks, which I've already mentioned, which is the actual assumed rate of return, a real return target, and maybe even an opportunity cost benchmark where you're looking at a mix of stocks and bonds to measure how your additional diversification is benefiting the program. So lastly, on private market benchmarking, so this definitely has its challenges. We did include a list here of those benchmarks that represent best practices or are the most commonly used across public pension systems. So in private equity, we used to only have one commonly used benchmark here, which was the broad public market index plus a premium. And that really works much better over longer periods of time, because when you have big swings in public markets, the private markets don't keep up, because the way that the companies are valued in the private markets is so lagged compared to what's happening in the public markets. But what we've seen over the last, I would say, 5 or 10 years is a massive improvement in the depth and the quality of peer universes. So we've started to see peer universes used much more frequently to benchmark private equity. And this can be used over shorter periods of time and provide good information. Core real estate uses a universe of other core real estate managers. That's what that NCREIF, what we call NCREIF Odyssey Index is and represents. For non-core real estate, we could either use a non-core peer universe, which also, again, has become much more robust over the last 5 years or so, or the NCREIF Odyssey, which is the core representative of the core real estate market plus a premium. And then for hedge funds, hedge fund research is a peer-based benchmark that they have by strategy. And there's an entire suite of those that allows you to get pretty specific with how you benchmark your individual hedge fund managers. So that concludes my prepared comments. I'm happy to take questions.
Thank you. So here, develop and be disciplined about an asset allocation model. You see that that's successful in the plans that you compare, and you do a lot of peer analysis. Is that right? Ann does a considerable amount of peer analysis. Do you?
We do have a decent amount of peer analysis, yes.
Have you taken a look at Pennsylvania? So the other thing I heard was that benchmarking and fiduciary responsibility, and that not all benchmarks are created equal, and you've got some best practices in that regard. So our first testifier, our consultant, talked about Pennsylvania and their benchmarks, at least in one of the systems, being set low compared to their peers. Do you have any information on Pennsylvania and its benchmarking strategies? And
So I don't work personally with any of the Pennsylvania plans, and I haven't done any benchmarking studies for Pennsylvania, so I don't know that I would be able to give you a good educated response to that
sure,
question.
is that data and that peer analysis, do you think, available through Aon, through your organization? Is that something that if we wanted to look at further, we might seek help and support from you?
Yeah, of course. And we actually recommend that our clients do a benchmark review every 3 years or so, just to make sure that all the benchmarks still make sense, because it is such an important component. And sometimes we'll tweak them. Sometimes new benchmarks come available, sometimes strategies change. And so that is something that we do on a frequent basis.
Great. Okay, thank you. Mr. Vice Chairman, question?
Thank you. Thank you for your testimony and for being here. You, when you talk about diversification, your chart on page 8 had the rebalancing as kind of a crucial tool to achieving the benefit of diversification, which
Right.
is, we heard two different versions of free lunch today. One was fees, the other was diversification. But if does that influence how we ought to think about levels of illiquidity? In other words, is the ability to, in fact, rebalance in the event of the earthquakes or other metaphors we've heard about today crucial to achieving that diversification benefit?
It is. So, yeah, I don't know what else I would say other than just to agree with you that when you look at your liquidity profile, that being able to rebalance in a stressful period is really important. Being able to rebalance and also to pay benefit payments, and to pay benefit payments out of an asset that's performing well or isn't down 20 or 30%. So certainly that's something that you'd want to take a look at.
And on the peer on benchmark, we could spend another day. We won't on benchmarking, but on the peer analysis, what's the right governance response if an institution is consistently, not this month, this year, but consistently low in a peer ranking analysis of performance?
I'm sorry, if they're lagging.
What would be the right governance response if you're over a long period low in a peer group?
So I believe the right governance response would be, especially if it's persistent, is to study it and learn about why it's happening and understand what might be different about the way the asset allocation is or the way that the performance of the asset classes is, and then determine if you think that there's something there that needs to be changed or tweaked or enhanced or improved. What I would say is, so I would use it, the way we like to use peer universe is as a source of information, but I don't think it should be a source of decision making, if that makes sense.
Great, thanks.
Okay, I think that's it. We appreciate you hanging out with us here till the end of the day, and look forward to further communication as we work towards wrapping up our project. Thank you very much.
Having me.
And last but not least, as we approach the end of the day, we've got, we've got Dr. Gregory W. Brown, Professor of Finance at the Sarah Graham Kennan Distinguished Scholar and Director of the Frank Hawkins Kennan Institute of Private Enterprise. We appreciate you joining us for lunch and then sticking around here to wrap up our testimony for the day. So thank you very much, Greg.
It's my pleasure. So I'm really just a professor of finance, and those are my administrative duties that are also other parts of my title. But thanks for the opportunity to speak to you. What I'm going to do in this talk is actually zoom out a little bit and think about things from a little bit more of a macro perspective and a long-term trend perspective. I think you all have heard a tremendous amount of very granular data. It's actually been, I think, excellent information that you all have gotten from the set of folks you've heard from today, and different viewpoints. I think really valuable viewpoint. I've actually learned a lot from listening to the presenters today. So I think the exercise you're going through is a really worthwhile one, and one that's rich with information. And I think what I hope to do today is maybe provide a broader context for a lot of these more granular issues that you've been hearing about. And what I've spent a lot of my career studying is just how financial markets have evolved over the last 50 years or so. And so I'm going to kind of walk you through what that evolution has been and why it's important to the investment decisions that are being made in institutional portfolios today. And I hope that provides useful information as you're sorting through, whether it's fees or asset allocation or other issues. So the way I think about what's happened in the post-war period is really there's been three eras in terms of capital markets. The first one is what I call the public markets era from about 1950 to 1974. There was this period after the financial collapse in the late 20s, during the Great Depression through World War II, where the attitudes towards investing in stocks and corporate bonds really changed, and people thought these were much too speculative investments for typical type of investors. Most institutional portfolios held just high-quality bonds and real estate, and I think people started to realize in the post-war period, as the track record started to improve for stocks, we started to see more academic work in terms of trying to understand what the potential benefits, risk and return benefits were for equities, and there was a resurgence in terms of public markets. And we saw, especially during the 60s and 70s, large growth in the number of stocks. We saw innovations like the NASDAQ and electronic trading. We saw the regulatory changes in terms of deregulation of commissions and things that led on through the 80s and 90s to significant growth and changes in attitudes about public markets. But I think really the kind of the heyday of that growth, that kind of renaissance period happened during the 50s and 60s. An interesting thing happened in the 70s, in the era what I characterize as essentially 1975 to 1995, I call the financial engineering era. There were very important advances, two important advances in the 1970s. One was theoretical. There was an academic framework that probably many of you have heard of, the Black-Scholes option pricing formula, but that's sort of the most famous outcome of a set of theoretical technologies that were developed that let you price a very wide class of financial instruments that previously people either hadn't known how to price or hadn't thought of creating yet and wanting to price. So we saw advances in derivative markets and the growth of derivative markets. So we saw the advent of exchange-traded options, things like financials, futures contracts, swaps, and another logical extension of this was structured debt products, so mortgage-backed securities and other more structured debt products. And there was a huge explosion in activity in those markets during the latter half of the 70s, in the 80s, and the 90s. And then that sort of plateaued, that innovation plateaued. I think people kind of invented everything that was useful and then started inventing things that maybe weren't so useful, leading up to the financial crisis. And there's been a little bit of a retracement in, and I'll show you a graph in a minute, retracement in terms of activity in this kind of financial engineering space. But then what's happened the last 20 years, what I call the private markets era, since the mid-90s, is we've seen the institutionalization of investments that have been around for a long time. People had sort of done private types of investments, but they weren't things that were structured in a way that made them attractive to institutional investors. And finance folks sort of figured out how they could do this type of packaging of assets and partnerships in order to encourage additional investment in this space. So I just want to walk you through a couple things that sort of show these trends pretty graphically. This first slide shows the number of publicly listed stocks, and we heard reference to this earlier today. that the number of stocks kind of worldwide really grew very significantly. This graph starts in 1980 and shows that the number of stocks went from less than 20,000 to about 45,000 up until about 2000 or so, and then started to plateau. If we look at just the OECD countries, the rich countries, there was growth over that same period, plateauing at about the same time period, but the growth was not as extreme, not nearly as extreme. When we look at the G7 countries, it's much flatter. And then the right graph shows what's happened in the United States, that actually the number of public listings peaked prior to the tech bubble bursting. It was during the midst of the tech bubble at above 8,000 stocks in the U.S. and has since fallen by about 50% to 4,000. So the universe of investable securities has contracted quite a bit. The wealth that's in the stock market has continued to increase because, as we also heard earlier today, the typical company has gotten much larger. So we have a smaller number of much larger companies. But the kind of characterization of the typical stock, the average stock, has changed quite a bit. This next graph shows what's happened to the over-the-counter derivatives market, which is an enormous market, and it just grew exponentially through the 90s and the aughts, and then peaked during the financial crisis and has been in something of a decline since then. But if we compare what's happened with those markets to what's happened with the private fund industry, this next graph shows the number of active private funds for three categories: equity, real estate, and credit. And you go back to the 80s, and there was really just a few hundred active funds that are in the databases that we have access to. And we think of these databases as sort of tracking institutional quality funds in some sense. And that number of equity funds grew very dramatically, and especially during the aughts and over the last decade has grown substantially. We've also seen an increase in real estate and other real asset funds. That's the green area there, so that they've grown to be kind of more than 1,000 funds in that space. And most recently, we've seen a big increase in private credit, private debt funds. The next slide shows the value of those funds, and it's grown even more rapidly in recent years because not only has the number of funds increased, but the average size of those funds has increased. So if we look at the actual value of assets, it's really exploded over the last 15 years or so. If we think about some other things that people typically put in the alternative investment space, hedge funds are certainly in there. There's been very rapid increase in the number of hedge funds as well, from around just a few hundred in the 90s to thousands of them today. Likewise, the value of assets held by hedge funds has grown from just a few $100 billion to more than $3 trillion. This is data that comes from HFR, which Chris had mentioned is a very popular source of data there. But if you the Office for Financial Risk, as part of the U.S. Treasury, has access to proprietary regulatory filing data for hedge funds, they think the number may be as much as $5 or $6 trillion. It's not always clear exactly what a hedge fund is. And then the next slide, if we look at what's happened to real estate, obviously the amount of dirt that's out there hasn't changed, but certainly the structures that have been built on it have increased substantially, and the value of that dirt has increased. So the size of the commercial real estate market has also grown by about almost fourfold over the last 30 years. So all these things sort of suggest that there's been very significant changes in the types of financial intermediation, the way capital formation has been happening in the U.S. And the way that I've been thinking about it is that in some ways there's an arc to the types of securities that have been available to public market investors. And and I think this is a pattern we're starting to see play out in other countries as well. So the U.S. has kind of gone through this arc. Other developed countries are a little bit behind us. Emerging markets are on the front end of it. But what happens is that as capital markets start to develop, there's a burst in activity in public markets. That's a good way to go out and raise money, but it's not always the most efficient way to manage risky assets for reasons having to do with governance, with fees, with how capital is allocated, research and development. And there's just certain types of companies that maybe they could be public companies, but they're even better served as being private companies. So, for example, they either never go public in the first place, and I'll show you some data on that in a minute, or they get acquired by another company that can manage the assets and activities of that company more efficiently. So, so what we track is sort of if you think about the average risk of a public company, it starts out low as a economy is developing. It starts to increase as public markets get more important, and then as private markets start to develop, some of the riskier companies either don't ever go public or end up being acquired. So the next graph I have here actually shows this using data. So it's time on the x-axis and risk on the y-axis, and it's kind of a complicated graph, but I think it'll make sense in a second here. What we've done is plot the risk of an average company by when it went public. So the black line, it's typically along the bottom there, shows companies that were public before 1967. And you can see that those are relatively low-risk companies and have stayed low-risk companies. And if anything, they sort of drifts down a little bit over time. And that's typical. Companies' risk tends to drift down over time. If you look at the gray line there, that's companies that went public from 1968 to 1977. They tended to be a little bit riskier. If you look at the yellow line, those are companies that went public from 1978 to 1987. They're riskier still. So, each decade goes by, there's riskier and riskier companies that are going public. And in fact, it's even the case today that the companies that went public in 2008 to 2017 are really the riskiest that we've ever seen. But the caveat here is that we just don't have nearly as many companies going public, and that the long-term trend for all the existing public companies is down. So there's actually been a decline in overall risk, overall riskiness of a typical public company in the last 20 years, which is very interesting from an investor perspective, because if we believe, let's forget about whether there's excess returns or alpha in markets. If we just believe that there's a risk-return trade-off in financial markets, then the risk of public markets has gone down, which means we would expect that the return associated with public markets would also be declining, just from a pure equilibrium perspective, nothing to do with picking the right stocks or anything, just what's available to investors. So, so why has this been happening? This next graph is copied from an academic paper that's circulating recently that shows that really the biggest effect has come from the decline in IPOs, that there's really been a dearth of IPOs, and the probability of a company that gets venture funding ultimately doing an IPO has declined to almost zero for practical purposes, whereas it used to be above 20%. Another interesting shift on the next slide is that if we think about the industry composition of public companies, it's also gone through a big shift. We all know that the U.S. economy has shifted from being very much a goods-oriented economy, in the early post-war period, to being more service-based. We see that reflected also in the types of companies that are publicly listed. So this graph, the bottom three colors there, the blue, green, and purple, are basically goods industries. They're basic goods, consumer goods, and business goods, which you can think of as machine tools and computers and things like that. So they used to be 80% of market cap in the U.S., and now they're down to about 50%. And of course, what makes up that decrease, the gap is filled by service companies, and those in three broad categories are finance, healthcare, and other services. So at the same time that the profile of risk and which companies are public has been changing, the industry composition of companies has been changing as well. So what does this mean for investors? I think it raises some important questions about how you want to think about asset allocation. We live in a dynamic world, not a static world. So we need to be careful when we look back at 20 or 30 or 40 years of data that we're not drawing inferences about the way things used to be versus the way that they're going to be in the future. That makes the problem harder because we can't rely on historical statistics as much. But I think we can still try to understand things that will inform the investment process. So I just want to walk through a few of those. So I guess the first most obvious one is, where are we in the evolution of alternatives? We've seen this huge growth over the last 20 years. Is this a bubble? Is it going to keep going? Have we leveled off? I don't think anybody knows for sure. My personal opinion on this is that that things are probably going to level off at about where they are. I think we're reaching near the saturation point on things like private equity and venture capital. I have a joke that I tell my kids every time I see one of the bike share things. I'm like, it's a sign of the venture capital apocalypse, right? We don't need like 14 bike share companies. I don't know how many you have around here, but it feels to me like, there's things that we've gotten to a saturation point in some markets, and it's always a cyclical business. But I think there's plenty of opportunity for the amount of assets that we currently have under management to persist. But whether we're going to see another doubling or tripling of private equity and venture type investments in the U.S., I would personally doubt it. There is a lot of room for growth internationally. Europe and developed Asia is a bit behind us in those markets, and emerging markets are very far behind us. So I think to the extent there's going to be new opportunities in private investment land, those will be disproportionately international. What does it mean for the value of investments and for risk and return in particular? I think there are good reasons to invest in private markets just because of, say, diversification. And I already said, like, let's take alpha off the table and just think, well, if now we have companies that are risky high growth companies that can only be accessed through private investment vehicles, and you want your portfolio to be exposed to those, then you have to be invested in private vehicles to some extent. That doesn't mean that you need to be 80% in alternatives the way that some endowments are, but I think when you believe maybe 10 or 20% of what would have been in terms of market value, what would have been public is now private, that's a meaningful allocation that you're going to want to have towards mid and small companies. So I'm going to talk a little bit more, this next slide, on what does this mean for investors. One issue when we talk about asset allocation and portfolio construction is that the problem is much harder when we want to incorporate private investments and alternative investments broadly in the portfolio. And the reason it's harder is because you don't even really observe the full universe of investments. Like, we're not even exactly sure what qualifies as a institutional quality investment right now and how to measure that universe. So you can't do the things that we typically teach our students, our MBA students, about portfolio optimization and portfolio construction. Like Kristen was saying, it's difficult to even meet some of the basic criteria for benchmarks in terms of investability, because you can't go buy the same office building somebody else owns. So if you're trying to benchmark yourself, it can be difficult to know what's really truly investable and what is sort of ethereal or a remnant of past investment decisions. So the first one is just trying to define what you mean by the investment universe. Once you do that, then you really have to think about what are the characteristics of that you think are most important for investment. We know that a previous testifier had talked about the risk factors, like the FAMA French risk factors. We know that things like size and the value growth characteristics, these are things that are important. Profitability, volatility of assets are things that are important for characterizing portfolios broadly. So to think about how you're going to get exposure to those types of factors with private investments is a bit more complicated decision, because you can't just do a regression model on stock market data the way you can with public equities or bonds. And the last one, I think, is that an interesting thing about a lot of private investment vehicles is you're delegating much of the investment decision to other people. So when you commit to a private equity fund, you're really telling somebody else, okay, you make these investment decisions for me sometime over the next 5 years. Right, so you don't know whether they're going to, draw half your money next year or in 3 years or 4 years, and they have. There's an agency issue here as well. Like, their incentives are somewhat different than the incentives of the investor. So how do you try to manage that additional layer of complexity, and is it worth it, right? I think these are important questions that we're just really starting to struggle with from a academic understanding with these newer markets. So I think I'm just gonna conclude with kind of going through what some recent research that we've done on endowments to try to make these a little bit more concrete issues. Endowments are interesting beasts to study. They were early to adopt alternative investments. They tend to be heavily invested. We heard about the Yale model today and endowment-style investing generally. There are investments like UNC Management. The UNC Endowment is about 80% invested in alternatives. So there's large, well-run programs that are very heavily invested. The typical large endowment has more than half of its assets in alternatives, and even small endowments through outsourced CIO models are getting into alternatives. So they're great things to study because they're a good lab. They have lots of exposure to alternatives. They also have really good data. So the trade association, NACUBO, for university business officers, has done a great job collecting annual data, fairly comprehensive data on endowment portfolios. And so we know what their asset allocations are and returns are and lots of things about who runs them and what their staff look like. So we've been able to go back and look at what their performance has been historically. And it's a great place to understand what are the risks and what are the returns associated with alternative investments. And what we've found is that there tends to be a fairly robust and large benefit associated with investing in alternatives, at least for endowments. That the endowments that are heavily invested in alternatives earn about 1% to 2% per year more on average than the endowments that are less invested in alternatives, and this is controlling for lots of other things that would matter. So it seems to be some real tangible benefit there. And interestingly, they also have lower risk. So they've been able to figure out how to create more diversified portfolios and earn a higher return by incorporating alternatives into the investment process. And risk is harder to measure with private investments because you don't get clean market prices on things. But even using what we think are high tech, high quality adjustments for the lags that are reporting lags, we're still able to show that it looks like there's a higher return per unit of risk, higher Sharpe ratio for endowments. So there's, I could go on for hours on this, but I doubt anybody here wants that to happen. So I'll just wrap it up there. And if y'all have any questions, I'm happy to answer them.
So thank you. Some of your testimony is consistent with Dr. Jenkinson, who has spent the day with us. We really appreciate that. And I may be back in touch with him because he's heard all the testimony today, and that's really great. And have you collaborated with Dr. Jenkinson?
Yeah, we've worked on a few projects together.
Yeah, that's terrific. One of the things we talked about was transparency in questioning him after the testimony. The idea that there's a growing sector of our economy and investments, and that businesses will continue to need capital, and thinking that with that need for capital growing sector, that costs will be driven down in the private equity space. Do you have anything to comment on that? And what do you see in the horizon for?
Yeah, I think they will come down. I don't. It sounded like Tim was fairly optimistic they were going to come down in the next 5 to 10 years. I think it might be a longer period than that, especially how hot those markets are right now. There was a lot of movement right after the financial crisis. It looked like we were starting to see some cracks on both the transparency side and the funding side. But as the fundraising environment has improved so much the last few years, I've heard what I would characterize as backpedaling on the lower fees and opportunities. I mean, they were always reluctant to lower fees, but they were providing more generous opportunities for co-investment and things that effectively reduced fees. I've heard, and maybe some of the investment staff here knows firsthand, that there's been an increasing reluctance for some companies to take money from public pension funds that are insisting on lower fees. I think that's indicative of the current fundraising environment, not what's going to happen long run. So I do think fees will come down as it gets to be a more competitive space. We're still seeing a lot of new firm creation as some of the more talented people come out of the larger firms and set up their own firms. So I think it's inevitable that there's going to be more competition, and that's going to compress fees. And Ludo's absolutely right that the theory says why would you give away your profits if you're generating all these excess profits? Finance theory says you should try to keep those, and that's what they're doing, and that's kind of what's happening. They give people enough to induce them to come into the space and then keep as much as they can. As the markets get more competitive, I think those pressures will come down on fees. So on the transparency side, I think ILPA has been effective in helping provide more transparency on fees, but I think they're just a fraction of the way there.
From the perspective of an endowment, maybe having a little bit more flexibility, investing heavily in alternatives, and I don't want to oversimplify this, but if you're, the holder of an IRA or a 401k and you've got a time horizon that you're approaching, you've got to be more conservative with your investments. And is that in this institutional space where you've got pension funds and you've got endowments that seem to be a little bit more flexible?
Yeah.
Is some of the reason maybe flexibility with endowments and time horizons?
Absolutely, and I don't think that that public pension funds or other types, to the extent we're able to structure things here so that defined contribution plans have access, that the allocations will need to be smaller. I don't think anybody can go out as far as endowments and foundations and some family offices that have very long horizons might be able to do. It's not prudent to take on that much illiquidity risk. Yeah.
Great. Thank you again for your testimony, Mr. Vice Chairman.
Thank you. I do think the endowment model is interesting, but also important to remember what the guru of the endowment model says to institutions that have different constraints than he does. I thought the David Swenson quote was interesting. One of our funds paid out nearly 6% of its beginning net asset value in benefits last year, which endowments have a spend, but it's a different kind of spend than the requirement we have to our pensioners.
Absolutely.
But I wondered, do you have a sense when you talk about sort of what percentage of private equity do public pension funds fund? In a
what percentage
ballpark
of the market is now made up? That is a great question. I don't know the answer to that. I'm guessing it's it's probably around a third to a half now.
Right.
But it's certainly increased in the last 5 or 6 years. Yeah.
I mean, it strikes me taking Dr. Jenkinson's point, who is still here, hats off for that, that individually we may not amount to much, although sitting around the pension boards, I notice the CEOs are usually the ones who show up looking for the contribution. Collectively, we are an extraordinary percent of the market. And you wrote an interesting paper, which I read, on the quality of data out there, in which you talk about the need for more transparency and standardization. I take it from what you just said to the chairman, you support the ILPA effort as a step in the right direction.
Yeah, I think ILPA has a cat herding problem in that they have lots of different people with lots of different objectives. But I think that they probably have as much ability and incentive to affect change as anyone. So I'd definitely support their efforts. Yeah.
Great. Thank you.
Great. Commissioner Gallagher.
Thank you, Mr. Chair. And again, thank you for being here, especially in light of Hurricane Florence hitting your state so hard. And I imagine Chapel Hill got hit pretty hard. I understand.
Got a lot of rain,
flooding,
but fortunately missed the wind.
Okay.
So.
All right. Well, thank you for being here despite those headwinds. Is it too soon? Probably. I'm sorry. Question about, we've heard a lot about alternatives today. And when I was in high school, I thought Nirvana was the only alternative thing out there. But is there an alternative to alternatives? I mean, I've heard conceptually that there's an ability to reflect the value that alternatives provide you, perhaps in an all ETF platform. Mm-hmm. Is that a realistic return profile prospectively? Is that a real tool that investors, institutional investors, should consider? Mm-hmm. Something or other concepts for alternatives to alternatives?
Yeah, so this kind of goes back to the discussion about factor risk, that you can try to isolate what are the unique factor characteristics of alternative investments and then find public assets that have those same characteristics and create these smart beta type portfolios around them. I think those have been a little disappointing, to be honest. It seems like there may be some sort of additional premium that comes along with the assets that are in private markets, either because the managers are adding value or they're able to pick off those things that really are going to perform better, some other special aspect. So it doesn't seem like you get that same premium that Tim showed when you look at these synthetic products. That's at least in the private equity venture land. For hedge funds, you're probably going to do better historically over recent history because hedge funds have been very disappointing as an asset class. If you do careful risk adjustment of hedge funds in the post-crisis period, the performance has been negative alpha. It's been below what you would have gotten if you had taken the same risks in public markets. Yeah.
Mr. Bloom?
This is a bit of an off-the-wall question, which I wanted to ask all day. Since the Great Recession, many minority and other diverse asset managers have left the business, gone to work for other people. And can you speak at all to the diversity component in the public market compared to the private market today?
Well, I think we can safely say that the diversity challenges in public and private markets are immense, right? And those are both women and underrepresented ethnic minorities. It's just it's a very difficult challenge for the industry in terms of specific numbers in public versus private markets, in terms of portfolio managers or senior people. I don't know those numbers. I'm not aware of any recent research. I know there's been a study out of Harvard. It's a few years old now. There's some folks at Caltech and Stanford that have done work in the venture space. But I think the conclusions on all of those is that the numbers are bad. Yeah.
Thank you.
Okay, ladies and gentlemen, I thank everyone for sticking with us for the day. I thank the commissioners for their work. I thank you for your testimony. Again, I'm certain that we'll be back in touch with you. We appreciate your expertise. We've collected a tremendous amount of information here today, and I thought that maybe after our third hearing that we would convene again. But, after giving it some thought, I think I may be reaching out to the commissioners to have another meeting. We'll see what is convenient, and if we can't get to Harrisburg, maybe we can do it via some other method with people that might not be able to get here, but maybe as early as next week. I think it's time to discuss some of the information that we've compiled so far as we go into the last hearing, because things are going to happen relatively quickly. So we'll be in touch. I thank everyone again, and I thank Joint State Government Commission for continuing to keep us on track. And with that, we will conclude today's hearing. Thank you.